What's up, ladies and gentlemen? It is your boy Chuck Taylor here once again. Gonna do a options tutorial part 2 where we're going to focus on put options. I hope the last video that we dropped was helpful with the calls. I haven't had any questions, so I'm just going to assume so. But anyways, so on my screen right now, I'm doing the same thing that I did last time. I have the desktop version of Robinhood up. I'm going to have SPY. We're going to focus on SPY today just to make it easier because everybody knows SPY, the S&P 500 ETF cash. And then I have my phone screen right there as well. But let's start real quick with what's a put option, right? So a put option is a contract giving the option buyer a specified amount of an underlying security at a predetermined price within a specified time frame. I hope that makes sense. It's kind of like call options, like where you have the right to buy at a certain price. Well, now you're buying a put option and it's giving you the right to sell a stock at a certain price, meaning you're betting that it's going down. But you're not obligated to sell them at this price. You could always just sell the premium, flip premium. Like I said last time, we don't exercise or any of that. We flip premium, fam. That's what we do. Um, I mean, just in a quick summary, and I'm going to get more in depth, but put options allow the holder, or I guess the buyer of the put option, to sell a security at a guaranteed price, even if the market price for that security has fallen lower. That makes them useful for hedging strategies. Kind of like I said last time, that options were designed originally as a hedging tool, um, as well as for, speculative traders, like which most of us are. Along with call options, puts are among the most basic derivatives contracts. Okay, so a put option is a contract. One more time, I'm going to just say this to get it to your head. Giving the buyer the right, but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. The predetermined price at which the buyer of the put option can sell the underlying security is called the strike price. Now, we went over that. It's very similar to calls. It's just you're betting the other direction. So I'm going to open up the SPY option chain right here. And then so you'll see buy, sell, and then you have call. And then we're going to focus on puts. And then you have your expiration dates. Let's do the 23rd of February because actually I am in some SPY put options on a different brokerage. For the 23rd. Hopefully y'all can see all this. So let's go down. So here's again, this is Robinhood's version of their option chain. Let's see. SPY closed the day on Friday at 498.35. Okay. I did, along with at Just the Success, I kind of tailed him on this play. Went ahead and purchased the 487 put strike, right? So once you click right here, and let me do it on the phone. Okay, so you can see that. All right, cool. It will bring up all the option statistics for that specific contract. But basically what what I'm doing with this trade is I'm basically placing a bet that SPY will be either at or below 487 by the 23rd of February, which I believe that's next Friday. Yes, it is. So, with that being said, I think I got them right around the price where they closed. I think I got them for 36 cents. But again, just like just like I was talking about with calls. Remember, each contract it represents 100 shares. So you have to take that 36 cents, multiply it by 100. So the premium per share is 36 cents, but you have to multiply it by 100 because all contracts represent 100 shares. So it's $36 per contract, right? Hopefully that makes sense. If SPY, okay, let's look at the statistics real quick, right? So you got the bid and the ask on the contract. So people are basically selling it for 35 or buying it for 36. The mid price is in the middle, so it's going to be 0.355. I don't think Robinhood will fill you like that. I don't know. Maybe. Most brokerages do. Robinhood usually keeps it at like around like some sort of rounded number. You can see that the last day it traded, which was yesterday, that the highest that the contract got was about 51 cents and its low was 21. The previous day it closed at 28 cents. And you can see all this on the phone as well. The amount of contracts out there in the open market for this specific strike price and this specific expiration, about 5,300 contracts on Friday. They changed hands about almost 8,000 times. The implied volatility is 14.74%. That's very low because SPY is not the most volatile equity or fund to trade. It's somewhat stable. It can be volatile, and it has been pretty volatile. But anyways, remember, if you remember what I said about your deltas and your what gamma and your theta and all of that is, your theta is your time decay. Remember, so negative 0.1128, and then the delta is basically represents the amount chance of it going in the money. If you're flipping premium, meaning like if you do not plan on holding this till expiration, which the only time you typically do these types of things, you hold till expiration, is because, well, you were wrong and it went up, or it just stayed flat and the time decay killed your contract and it's worthless. So what's the point of even trying to sell it? I mean, want to, unless you want to sell, have the right to sell 100 shares per how many contracts you own. If you're actually right, if SPY goes to 487 or below by Friday, I just don't see why anybody would want to do that. So, I mean, some people do. Mostly, it's big time traders, institutions. But typically, if you're an option trader, you're in it to flip the premium. So let's just say, because Monday, first of all, the markets are closed on Monday for President's Day. But let's just say on Tuesday when the market opens, SPY, right, let's just say it's like 487 is going to be right about here, and it's trading up here. So it's got a ways to go, and it's definitely got some pretty heavy support right here at about 480, or 490-ish. I'm sorry, I can't read. But yeah, so if it starts to fall, which it looks like it kind of starting to roll over a little bit, it kind of started to look like that actually earlier in the week or the day before. I mean, I'm sorry, and then it rebounded. But anyways, what I'm getting at is come Tuesday when the market opens and SPY is now trading at, so where did it close? 498. Okay, so 498. Let's say SPY is now opens up on Tuesday morning and it's down to like 494. Okay, your strike price is not, you're still out of the money, but given the fact that it moved down a few points, a few dollars, your contract should most likely be up. Let's just put it this way, for about every 1% that SPY moves down, your contract should gain about 100% in value. Now, that is if it happens basically immediately upon your purchase. If, it takes a little bit of time and it chops around, it goes up, it goes down, and, your time decay is going to come in and start to hurt you there. But that's really the basics of kind of, it's very similar to call options. It's just the opposite way. Um, and again, you just need it to start to move in your direction. Now, if it goes in the money, I mean, that's when you can kind of really not really have to worry about the time decay as much anymore because it's in the money. Typically, you want it if it goes in the money, especially pretty deeply in the money, meaning like SPY's got down to like 485, 484, whatever. You probably want to flip that premium and sell it off just to get your profits, and then you can pick another play. It always honestly it depends on how much time you have left till it expires when SPY makes that kind of move. Now, if SPY just stays stagnant and just chops around, time decay will kill the contract. I mean, these are really cheap. Okay, these are very cheap contracts because what are they like? Just about $11 out of the money or so, and they have like 6 days till expiration. So that's why they're priced at that level now. SPY, but you will notice if as SPY continues to these contracts right here as it dropped like or as you get closer to the money your puts they gain value in premium just like calls. It's the same thing. Well, the only real difference between call and put options is well, one, it's the way you're projecting the underlying to move, and at the same time, uh the one thing about puts, now you don't really have to worry about this unless you're trading like I don't know, an underlying stock that's very cheap. Let's say, okay, you trade puts on something like Virgin Galactic, which I used to back in 2021 when they I made a killing on their run. I mean, they had a stellar run. But anyways, yeah, we'll look for the 23rd. The one problem with trading put options on an equity that's so low in price, do you see how limited your strikes are to the downside? That's because you're capped because the stock can only go to zero. So if it goes to zero, if you're betting on it literally going, I mean, there's only a limited amount you can make. Now it calls the sky is the limit, right? Because it can just keep going up. I mean, there is no ceiling for stock. That's why it's dangerous to, especially during earnings with these really, really low priced equities to buy puts, especially when they're very close to zero because you're you're literally capped on your profits, and I mean it would have to go to zero for you to even make the max amount possible. And if it's earnings, usually the implied volatility is extremely high. Um, so it could kill your contract. It could go down to 50 cents and you'd still probably not make money off of it. So stay away from these people. Do not trade really, really, really just underperform. I mean, just look at the chart on SPC over the past, 5 years? It hasn't even been 5 years. Or just max. Like, look, this is when I was playing it. Oh, sorry, right here. I played it right here, and I made a killing off it. But look at this. It's been down. It's crushed. It's absolutely just crushed. So be careful playing low priced stocks for puts, especially during earnings season, as well as just in general, because you're capped on your gains. Because if the most you can make is if it goes to zero, and it's not very often that a stock goes to zero. Okay, even a stock like this, so anyways, they're probably going to get delisted. Yeah, but so on the watch list, you can do a simulated my returns thing, and it'll show you like as the price, let's say it goes to 490. Yeah, okay, so 490, and then here's your date, right? So the market opens on so on Tuesday, if it opens up at 190, well, just about 190, each contract should be up mm, about $85. Meaning the contract should be priced at about 121 when you bought them at 36. So just gives you an idea. Okay, I think option profit calculator is a little bit more on par. You can do it with the desktop too, but I mean, honestly, why? We don't need to. Or we'll go to like a 1 hour. Um, Then you go to the option chain right here. Cool. What did I say? The 23rd. Boom. You got calls, puts. All right. And this helps you really visualize kind of better than Robinhood, like what's going on. So, but yeah, this just gives you a better idea. You can see kind of how this works, right? So the further on the put side, out of the money, this is calls. Remember, these are in the money calls, out of the money calls, in the money puts, out of the money puts, at the money puts, at the money calls. As you can see, the further that you go into the money, because my strike's down here. So as it comes closer to your price, you can see the value, obviously, gain, add up. And you can also see the implied volatility will continue to rise the further out of the money you go, and also the further in the money you go. And that has to do with just liquidity, because not a lot of people are trading like super, super, super deep. Sorry, out of the money is this way on puts. In the money, see, a lot of people don't want to trade super expensive, premium priced puts. There's like no volume here, and that's why the implied volatility gets higher when you go super, super in the money on certain things like that. Now, it's SPY, which is relatively stable again, but that's how you look at it on Webull. Again, I mean, I think it's a great charting tool. But let's head back to the Robbie, or you know what we can do actually? Let's do the option profit calculator. Okay, cool. Yeah. So we're gonna do long put. We're gonna go SPY. Is that where it was trading at? 498.35 is actually where it closed in after hours. Okay, cool. Now we're gonna go to, we're not gonna write these options. We're not selling them. We're buying them, right? So we're gonna select option, click your expiration, got calls and puts. So we're gonna go to 487. Right here, about 36. That's exactly what I paid for them. And I grabbed 10. So I spent $360 on this play. And we're going to calculate it. So I'll give you a good range, basically from about 508 to 484. This is where we're at right now. But this, and this is, you can change this up to give you an idea of kind of like how much money you can make, depending on how many contracts you have or whatever. So come the 20th, actually, let's do this. Let's change the date range because it's a 3-day weekend. And honestly, it just wouldn't make sense. So there we go, the 20th. Let's recalculate that. It's not going to look as good, I promise you. So if it opens up right here at like 498, yeah, so I'll be down about 72 bucks. But if it, as you can see on the 20th, you know, if it goes to, if it starts to get closer to the strike price, I can be up about 400 something bucks or 500 something bucks, 600. But then, if it takes more time to do this to get to the strike, each day that goes by, that it loses value. And especially it starts to lose value like astronomically quick as you really do approach the, wait, did it not calculate it? Yeah, it did. Regardless, remember optionsprofitcalculator.com. Now back to the hood. So anyways, so all you do really is you look, if you want to get into the play, I never recommend buying options on what's it called? The weekends, or when the market's not trading, but you can put in 10 cents, it's going to get 36 cents, and boom, there you go. And you can do limit orders, or you can do stop limit orders and all that kind of stuff. But typically you want to be opening the trades when the market is open. You do not want to put a place a trade when the market's closed and let it just sit there, because you have no idea where it's going to open up. So I do not recommend that. All right. And it's basically the Wikipedia for stocks. So you can go over here and be like, hey, put options. Then it's going to come over here and explain all of this to you. You can even watch a video. How cool is that? I don't know if we're going to do that, but
About puts and calls, it's important that you have something to relate a put or a call to in your ordinary life.
I don't need him to do my job for me. I know what the hell is going on here. So, um, excuse my language. Get out of here, man. Um, all right, your key takeaways on puts. Put options give the holders of the option the right, but not the obligation to sell a specified amount of the underlying security at a specified price within a get away. Uh, to sell a specified amount of an underlying security at a specified price within a specified time frame. Put options are available on a wide range of assets, including stocks, indexes, commodities, and currencies. Put option prices are impacted by change in price of the underlying asset, the option strike price, time decay, interest rates, and volatility. Remember when I told you in the last episode about your intrinsic values and your extrinsic values on options. I'm going to go over that here in a second again, just one more time. Put options increase in value as the underlying asset falls in price, as volatility of the underlying asset price increases, and as interest rates decline. I don't know why they call it interest rates. It's so stupid. It's kind of like the implied volatility or whatever. But put options lose value as underlying assets increase in price as volatility of the underlying price decreases as interest rates rise as the time to expiration. Again, this is just giving you a real quick, contract put option, a contract given to the option buyer the right, but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. Coolio. All right. Um, I've kind of talked about all this. Here's the intrinsic and extrinsic value stuff, which is always very important. Okay. In general, the value of a put option decreases as its time to expiration approaches because of the impact of time decay. Time decay accelerates as an option time to expiration draws closer, since the less time to realize a profit from the trade. When an option loses its time value, the intrinsic value is left over. Okay. We're going to go over what all that means again. An option's intrinsic value is equivalent to the difference between the strike price and the underlying stock. If an option has an intrinsic if an option has intrinsic value, it's referred to as in the money. Important. Option intrinsic value equals difference between market price of underlying security and option strike price. For put option, I IV equals the intrinsic value. I hate when they do that. I hate when they use the term IV for intrinsic value because it just confuses people, because IV is mostly used to describe implied volatility. Anyways, intrinsic value equals strike price minus market price of underlying security. For call options, intrinsic value equals market price of underlying security minus strike price. Basically, intrinsic value, there's two things, like if the stock is going up or down. That's your intrinsic value. Now, the extrinsic value is all of this stuff: your implied volatility, your volume, your open interest, all your Greeks, your time decay. That's the extrinsic value. So basically, what that was saying, in a sense, was that it loses all of its extrinsic value. Um, especially if it's like on the day of expiration. I mean, the only thing that at that point, it's always going to have intrinsic value because it's based on the underlying. Okay. But its extrinsic value can literally, that's when you're going to have issues, and it's probably going to go worthless unless at the very end of the day on expiration, like SPY decide, the underlying decides to just absolutely just tank. And you get lucky, but that's doesn't usually happen that often. Um, you know, so that's kind of the gist of like how I hope that makes sense. I mean, you know, it can be a little confusing, but it really isn't. Yeah, you know, it's and again, if you're day trading puts or whatever, like, you know, if you're day trading them, you don't really need to really worry so much about the extrinsic value because you're going to be in and out of the trade pretty quickly. Um, so you're not it's not it's only when you're holding them for some time, right? You know, either a couple days, week or two, that's where you got to kind of pay attention to the extrinsic value because at the end of the day, if you're going to buy a 0 day expiration, come on Tuesday or whatever, Tuesday, you market opens up and you want to buy, let's see, let's just say Spice opens right where it is right now, and you're like, okay, I think it's going to go to 496. Okay, so it'll cost you about $47, okay, per contract. You see what I'm saying? Like, you just want it to move down. Okay, you just want it to move down kind of fast. Doesn't need to go in the money, especially if you buy it and immediately it starts going down, you will see the value of the contract. It'll gain value. But your problem is when it's a contract that expires on the same day and it doesn't move in your direction, like, or it kind of just chops around, you'll start to see the time to gate come into effect pretty quickly. Um, or if it moves up, it goes the other way, you'll really see the value of the contract lose its value. So, you know, it's not something that you really need to watch out for a day trade. But if you're swinging, multi-day holds, week over week hold, whatever, yes, you do. It's very important to understand these metrics because they will affect your, um, you know, your premium. Okie dokes. Um, I really don't know if I can explain that any better. Now, look, there's all sorts of other ways to trade options. Like, there's all these different kinds of strategies that they have. Look, I mean, you know, doing these spreads, I don't recommend it. Straddles, we'll make a whole video about that. But right now, I know most of you people are, I mean, it is kind of helpful. It's like, okay, I think it's going up. So you click this, right? Single leg, you can cover call, cash secured put, call debit spread, put debit spread. Those are your going up plays. But the long call is what most people play. Or the going down, the long put, call debit spread, put debit spread. You think the price will go up or down? That's going to be called a straddle or a strangle. I don't personally, I mean, they're good in certain circumstances, but typically I don't like to play those. Maybe during an earnings or something, maybe. Calendar spreads, you're simultaneously you buy and sell similar options using different expiration dates. Like, calendar spreads are designed to profit from differences in implied volatility. Like, it's basically like buying a call that expires tomorrow, thinking that it's going to go up, but you also buy a put like further out in expiration, thinking that it's going to go down later. I, you know, I'd rather just buy the call, sell it, and flip into puts instead of doing that. But you know, a lot of people have the, and then you have this, which these are ridiculous. They also, well, they're calling it a long call calendar spread or like a long put calendar spread, but for the most part, these are mostly known as iron butterflies or iron condors, where basically you think that the price is going to stay within a range. Again, these are more complicated multi-leg strategy options. I don't really recommend them unless you absolutely understand what you are doing. I will go into that in another video, but I know what most of you guys like to trade, and it's usually just calls or puts. So we're just focusing on that. Time value or extrinsic value. This is the extrinsic stuff I was talking about, is reflected in the premium of the option. Because remember, you're when you buy an option, a call or a put, remember it's you don't own the stock. You're paying a premium to have the right, but you're not the obligation, but the right to either buy 100 shares of the underlying on a call option if your strike price, if your contract goes in the money. Meaning if you buy call options on SPY, it's trading at 498.35 and it goes to 505 and you bought the 500 call, well, you could technically, right, you could exercise that contract and own 100 shares and you could buy it at 500 when SPY is trading at 505, meaning you could sell those, you could sell you could sell the damn shares for 500. I mean, you could sell them for 505 and you get the right to buy them at 500. But I don't understand why you would do that when you could just sell the premium of your contract, that you just, the value of the contract gone out so much that you just flip the premium. And why make it so complicated? Plus, do you know how much money you have to exercise just one contract of SPY? Let's see, 500 times 100. You need $50,000 to exercise one contract if you bought the 500 strike. Okay. So it doesn't make sense to do it. And then with the puts, it's the basically the same thing. It's giving you the right, not the obligation, but the right to sell. Okay, to sell 100 shares of the underlying if it goes in the money. Again, we flip premium. We don't exercise. So that is that. And again, like the option chain. I mean, you just, if you're exercising, you either have a ton of money in your account. It's more of an institutional thing. It's a hedging tool. You like think about this for a second. A put option, right? Like let's say you own a shitload of SPY, like just the ETF, like just shares, right? And you've been riding this wave up and you don't want to sell your shares, right? Because like, you for long term, you don't want to sell your shares. You buy the dips, right? But you don't typically just sell out. So what you can do is if it starts to come down, you just buy put options kind of as a hedge against. So you can gain money as your stock is going down, your put premiums will go up and it should kind of hedge you out. And then at the dip, you sell the puts and then you buy more of your stock and let it go back up. That's where I'm telling you, that's how, and that is what options were literally designed for. They were hedging tools, but that it's turned into a whole nother thing now, especially with the 0-day expiration things like the it's gotten so popular. It's crazy, and it's honestly that's you now options are used basically to kind of see where people think the market is going. It's the derivatives market. You're placing a bet on top of which direction you think something is going to go, and you're paying a premium for that. And it's over the years, like over the past 20, whenever, 30 years, they use now the flow of option premiums to kind of gauge which way that people think, or the market is dictating which way the market's going to go. So it's kind of fascinating. I hope that makes sense. On that note, I think that covers just about all of it. I really, I don't, I know it is complicated, but that is the easiest way I can break it down for you. Um, I can get more granular with it on another video, like literally, like kind of like how you can do the math, like by looking at an option chain and seeing why it's priced that way. Hopefully that kind of gets it across. Just remember, call options, you're betting on the price going up. You get to pick your expiration date. You're paying a premium. Put options, you're betting on it going down. You got an expiration date. You're paying the premium. You got your intrinsic value, which is based upon the movement of the underlying, and extrinsic value, which is all your time decay, your Greeks, your implied volatilities, and everything like that. That's what you need to know. And with that being said, I'm going to go ahead and cut the video here. And